So what's the first thing that happens when you get into investing? Everyone recommends just putting your money into VDHG. So in this video, I'm going to provide you guys with some single ETF options to consider besides VDHG, depending on your risk tolerance or industry preference. Hey, my name's Michael, and if we're meeting for the first time, I'm here on YouTube sharing all the mistakes and lessons I've learned about investing and growing passive income streams. If you haven't heard of VDHG, or if you just want a reminder, check out the video in the description below where I go into the pros and cons of the VDHG ETF. Anyways, let's get into it. Here's a summary on your screen about all the different alternatives I'm going to go into about single ETF alternatives for VDHG. I'll go through them from highest growth potential, so the most riskiest, all the way to more conservative. And for all the ETF options that I am going to provide, I will make sure they are all at least reasonably diversified. They are Australian domiciled, so no annoying tax. And what I would consider decent alternatives for people who want a single ETF to invest in besides VDHG. So just for a reminder, up on your screen will be a snapshot of what VDHG roughly looks like in terms of sort of fees, returns, dividends, and allocations. Let's get into the first one. So the first one is an ETF called Tech, and it basically invests in global technology companies that have a significant competitive advantage over their peers. So on your screen, you can see how it compares to VDHG. It's a lot less diversified and obviously a lot more focused on a single sector, technology in this case. Tech is a good alternative for someone who wants an easy way to diversify across the world into global technology companies that have quite significant competitive advantages compared to some of the other peers in their industries. I guess the big downside for picking tech as a single ETF option would be that you really only get exposure to a single industry. So obviously quite a bit of risk there. But if you're someone, like I said, that is very bullish on technology, tech is a great single ETF to get global exposure to this sector. The next alternative is for somebody who wants a single ETF to get exposure to the best companies in the US. And that's through the NDQ ETF. So I know that there is VTS to provide total US market exposure, but there was a reason I didn't want to include that as an alternative in this case. And that's purely because it's actually US domiciled and didn't fit the criteria of being an Aussie domiciled ETF. So again, you can see that NDQ is quite a bit less diversified than VDHG. With only 100 holdings, much higher fees, what do you get for it? You get much higher returns. NDQ is a really good alternative for someone who wants exposure to market-leading companies in the US. And as it turns out, the majority of these are actually technology companies or companies that are really innovating in their sector. And a good bonus of the NDQ ETF is that you do get a lot of exposure to companies that are pretty underrepresented in the Australian market, such as sort of Amazon and Google. So the next alternative is an Aussie-focused one, and that's A200, which tracks the top 200 companies on the ASX. I specifically didn't choose VAS here because I actually like that A200 has lower fees than VAS, and it provides a very similar return in terms of the index it's tracking as well. VAS includes the top 300 companies, A200 is only the top 200 companies. So I think what makes A200 a great single ETF option is that it just has such a low management fee. At 0.07% per annum, it's practically almost free. And for someone who just wants a single ETF to put all their money in, it gives decent exposure to the Aussie market. But be a little bit careful with A200 or VAS or any just single ETF that's only investing in Australian companies. Purely because if you're living and working in Australia, you potentially don't want to have all of your shares also in Australian stock investments as well. Hey guys, if you're getting any value from this video, please smash that like button, as it really helps out with the algorithm and it might mean someone else might be able to find this video as well. So the next alternative is for somebody who wants a single ETF for Asian market exposure, excluding Japan, Australia and New Zealand. So VAE's got over 1,000 companies, so decent diversification. The management fees so-so, but the return's actually been quite good. When you look at VAE versus VDHG, it becomes quite a good alternative for buy and hold investors who want sort of long-term capital growth and international diversification across the Asian economies. About half its holdings are in China, so that is something to be aware of. But it's great as you get huge diversification across a bunch of Asian countries which are all developing at fast rates. And it allows you to get that diversification outside of your home country. So the next alternative is going even wider than VAE. We're going all emerging markets. VGE aims to get total market exposure to companies listed on emerging markets. And it has over 5,000 holdings, providing really great diversification across these emerging markets. So VGE basically gets you exposure to China, Brazil, India, any sort of emerging country, and it gets you small, mid and large size cap companies in those markets as well. So it's a really great single ETF alternative again to provide all that diversified exposure across all the emerging markets for someone who really doesn't believe in the sort of developed markets in terms of long-term growth anymore, and really sort of sees a future in those countries like India, like China, like Brazil. So this next alternative is really for somebody who actually likes VDHG mostly, but just doesn't like that 10% bond allocation that's required as part of it. And it provides all-world exposure in a single ETF. But because it doesn't have bond exposure, it's obviously a little bit riskier. And the ETF that I want to suggest is this one called iWorld, ticker IWLD. And like the name suggests, it gets you whole world exposure to large, medium and small size companies. iWorld itself actually holds 4 ETFs, but in those ETFs there's around 4,000 holdings at the moment. And it's got a really low management fee at only 0.09%. So iWorld is probably the most diversified option that I'm going to show you in terms of providing a high growth alternative to VDHG, because there doesn't have any bonds that it's holding and purely only equities. A great option with really low fees. So this next option is really just for somebody who doesn't like Vanguard for some particular reason and wants an option that's similar to VDHG but not provided by Vanguard. And that is BetaShares' competitor called DHHF. It's extremely similar to VDHG, trying to provide the same return at 90% equities and 10% bonds. It has over 8,000 holdings and a management fee that is 1 basis point lower than VDHG. So with DHHF, you really just have to expect the returns and dividends to be extremely similar to VDHG. The one thing that I would consider is that it is a bit of a newer fund than VDHG and doesn't have quite the track record. And Vanguard has actually never ever closed a fund that has opened up. So that is something to keep in mind if you don't want to have to move your money around later. But also it's super unlikely anything happens to BetaShares as well. So this last option is a bit more of a conservative one called VDBA, but it's actually the same diversification in terms of the equities that it's holding. It just has a greater weighting towards bonds at a 50-50 balance between growth assets, equities, versus more conservative assets, bonds. So it has the same low management fee as VDHG at 0.27%, and it provides the same diversification as well in terms of the listings. But it just allows you to have a bit more of a conservative long-term focus in that bigger bonds holding. What is interesting to note though is that over the past 20 years, give or take, it's provided a very similar return at around 7-ish% to VDHG. So there you have it. That was 8 alternatives to VDHG at varying different levels of risk and diversification, as well as industry classification. If you found this video useful at all, please drop a like and subscribe for future videos. Let me know in the comments if you think there's an ETF option that I missed. Thanks for watching the video, and I'll see you in the next one. Peace.